Thank you so much, Katie, for hopping on our podcast, Winning the Home Game. And, just to introduce who you are before we actually start getting going here, is that, you have helped me, especially throughout the last couple of years on our amazing, unique products that we have at Cross Country Mortgage. And these products are non-QM products, and we'll go over what that really means. But you are truly a bright star. And I'm going to tell everybody thank you for helping me out right now because you've been just so instrumental in helping our clients, with these particular products. So I wanted to tell you that first.
Thank you so much. I really appreciate it. I mean, it's honestly a pleasure. I'm a former originator, and now I get to work with loan teams across the country and win these deals for clients, help achieve their dream on a national scale, way more than I could do like personally. So I feel like it has a much greater impact, and your team is obviously great to work with. So we appreciate the partnership.
Oh, it's a great partnership. So thanks again. Okay, good. So we're going to jump in with some questions and, we're going to get started. This type of concept of products that we have the regular box products, right? Clients may be going conventional, FHA, VA, or jumbo, but these products that you help us, with our clients, are they out of box products? So we're going to talk about what that really means. So for those people that are listening, these are not the normal products, but they help so many people achieve home ownership. And it's a very important part of our product line that we have for clients. So, for listeners who, are meeting you for the first time, tell us who you are, what you do at Cross Country, and what led you into the mortgage industry. You kind of talked about it a little bit, but go into it again.
Yeah, of course. So I'm Katie Daum. My actual role is I'm the sales executive here at the corporate office in Cleveland, working for Cross Country. And really, my role is that I exclusively support the loan teams throughout the country and working with these products. The owner of our company brought this whole platform. In-house. So it's really exclusive. What we offer here are proprietary and exclusive programs. And they built an entire sales team to really support and reinforce these programs and serve as a resource to loan teams. A great thing about cross country, we have every product you can imagine. Sometimes that can be hard to navigate for a loan team, and especially when they have a specific scenario, they can reach out to us for immediate guidance. So that's really kind of what my day-to-day is I answer calls, I answer emails, questions. Hey, Katie, we've run into this situation. Do you think that this might be a good fit for the program? A huge part of what we do, and I think really what makes our programs very special here, is that we offer a lot of exceptions. So we're starting with guidelines that are already provide a little bit more flexibility based on really, I would say we take an approach of looking at the client's true financial and income profile. Right. And not just making it fit into a standard guideline. So we take a real personal approach to that. And we make exceptions to our guidelines very often. So it provides further flexibility to really bridge that gap in someone's situation to help them achieve their dream of homeownership.
I love that. And when you say exception, can you give me a brief example of what that means?
Sure. And I think this is probably one that's really common in your market, right? And I work with a lot of West Coast folks, and given the employers that you have there, I think RSU income is a
Mm.
is a big is a big driver of income for many clients. What makes it sometimes challenging is that there can be inconsistencies. They have large sign-on grants, and in the traditional world, how they view those types of income, a lot of times they don't qualify at all. And so where our guidelines might have some requirements, again, we'll take a really individual approach. We have an entire team who has authority to review these files against our guidelines and then say, you know what, we think that this is a borrower who has a great ability to repay, looking at their assets, looking at, maybe previous history of RSU, what's the projection for the future, and then making it, an exception to say, this loan doesn't meet what's written in black and white, right? But we're going to issue an approval to proceed with this file.
I love that. And I think that's probably one of my most favorite parts of the non-QM products is that our team is able to get exceptions
Right.
which is, it sounds crazy to me because we're so used to like the vanilla, it's yes or no. But these products allow us, like, hey, if a client maybe has a little bit lower credit score, also because of, something that happened in the past, but you can see that they have reserves and, there's no lates, then that's something you can make a, decision on, which is really, really helpful. You're looking at that client individually, and I love that.
Right. I think that, one thing that I think is wonderful is that we really look at the individual behind and their
Mhm.
story. They're not just a number.
Right.
Because there's behind every document that you're getting, there's a borrower behind that, right? And
Right.
they have a story. So for us, it's like, can we help that story have a happy ending, really?
Right. I love that. Great. So let's talk about the real definition of non-QM. What does that really mean for our company at Cross Country?
Well, maybe I'll just answer what it means in the industry because I think that, and then I'll answer for us here.
Okay.
Um, I think that non-QM has become a buzzword in our industry over the last 2 years, right? So it's important to understand that's a tagline almost that everybody uses. So the textbook definition of non-QM is it's a non-qualified mortgage. These programs assess a borrower's ability to repay and using alternative methods of documentation and calculations, for example, for their income. Whereas traditional guidelines, conventional guidelines, those requirements are created by entities such as Fannie Mae, Freddie Mac, in the case of a government loan, FHA, or VA, right? And those are very much set in stone. Um, so that's the textbook
Right.
definition of a non-qualified mortgage, of non-QM. It's a non-qualified mortgage,
Right.
meaning it
Perfect.
doesn't meet those standard guidelines.
Right. Okay. Perfect. And what do you think is the biggest misconception people have about non-QM loans?
I love this question because this is a hot topic for me right now. I was reading a lot of things last week and even on LinkedIn. So I think the biggest misconception is
Mhm.
that non-QM is the modern version of subprime,
Mhm.
circa the loans of 2006 that really crashed the housing market, right?
Right.
This couldn't be further from the truth. Most non-QM borrowers have very strong credit profiles. They have strong financial assets and reserves, and they have documented income. But the challenge for those folks with qualifying for traditional mortgages, often how they earn the money, it doesn't line up with the traditional guidelines that were created maybe decades ago and haven't really kept pace with the modern economy. So our guidelines in non-QM are really designed to adapt our underwriting model to today's economy.
Mhm. I love that. And who do you think is the ideal borrower or buyer for a non-QM loan?
I'll give you some examples of professions. Some might be surprising to people. So, business owners are kind of, I think, the obvious one, right? Real estate investors, another maybe more common fit for our products. But you have physicians, you have consultants, a lot of gig workers, independent contractors, executives with stock compensation, like I mentioned, the RSU, or even retirees that are living on assets. Or you might have individuals who recently sold a business or a home and they have a large reserve of cash and they can use that in lieu of actual monthly income to qualify for the loan.
Mhm. I love that. And, one of my favorites is, somebody who owns a business, right? Like you mentioned earlier, because, rightly so, they're taking a risk, right? They're putting
Right.
money on the line, building their business. But part of being a business owner is you get to write things off, right? But they're making money. You can see it coming into their bank account. So this has been such a benefit for our clients who are business owners, can't show money on their tax returns, but there's other ways that they can prove it to us. And they have great credit, they have assets. So that's probably my favorite way that I see non-QM work in my area here too.
Yeah,
So
and I would say that's the case for most people. Many will argue that the bank statement program is
mm,
the most popular non-QM program in the country. And
mhm,
I think that that's really a byproduct of, again, the shift in our economy.
right.
Projections are by 2027, up to 50% of Americans will be earning some portion of their income independently. So if you think
Wow.
about that, like how many people then don't fit in those traditional boxes?
Right, right. I love that. All right. So we have a lot of listeners in tech and self-employed professionals, like we talked about. How do non-QM loans help buyers with bonus income, RSUs, business ownership, or more complex income situations? You kind of gave us already examples of that, but what other examples can you give us?
So with the bonus, I think again, it's taking that approach of really looking at the numbers on paper, previous, projected. Can we make sense of that? And so instead of just taking a hard line of like, you need bonus income for previous 2 years, it must continue at X level, which is again the conventional approach to that. We're really going to look at what is their ability to repay this loan.
Mm,
That's kind of the litmus test, right? And we may have multiple ways and various approaches to calculating that and reaching that determination that fall outside of not only traditional guidelines, but the guidelines that we have for our framework. Again, it's taking that individual approach.
mhm. Okay, great. We touched on this a little bit, but let's go into it again. What's the difference between a traditional mortgage and a non-QM loan in simple terms? So, people can understand it. We can go back and forth with all this language, but for the buyers or maybe realtors listening, how do you break that down simply?
So simply, I would say these are guidelines that are built for today's modern economy and the way folks are earning their income, which
Mm,
again doesn't really line up. If you look at 10 years ago, go back 20 years ago, look even in the past 5 years, look at what we're seeing in AI, and you're in a market where you're seeing a lot of that, right? You have new professions entirely, new industries. And when we update our guidelines quarterly, so we're very fast to move with the market. Uh, you can probably speak to this better than I can, Julie. How often outside of update to language or a clarification of a guideline do you see an entity like Fannie Mae or Freddie Mac actually revise guidelines entirely to offer flexibility
yeah,
to
so
keep
rare.
up with, right? To keep up with what changes we're seeing
Yeah.
in the workforce.
Right. So rare, to be honest. Maybe one or two, or maybe at the most three a year, and
Right.
that's being generous. But with non-QM, like things are changing. We're opening things up, for this situation or that situation. So that's what I love about these products because we have more control over that.
Yes, 100%. Because
Right.
everything is done here in house at our company.
Right. So the bank statement loan, we talked about that a little bit, but can you just go over like how do you calculate income for like a business owner that doesn't show income on their tax returns, but we can see on their bank statements they are receiving income. How do we calculate that?
So the easy way to explain it is that we'll take 12 months of bank statements. Like generally we can take 12 or 24, but let's make it easy, right? So 12 months of your bank statements. We'll look at all of your deposits coming in. By the way, we're not looking at the withdrawals. Many people think that, right? We're just looking at money coming in.
Okay.
We look at all those deposits that we can verify as business revenue, and we add all those up and then we divide by 12. And then there's a calculation that we'll use to determine like an average expense ratio. That's determined by the type of business, as well as like the headcount of the company.
Mm,
And so there's some flexibility there too. Using easy numbers, let's say we'll take all of the deposits and divide by 12, and then we're going to give credit for half of that. But that I
mm,
would say is the more conservative approach in our guidelines. There
mm,
are options depending again on the size of the company and the type of company, right? And whether they're like providing a service or selling goods,
mm,
that's further reduced. So I think it's a really important point because we often talk, and it's easy when we have these conversations as industry professionals
mhm.
to use these terms, and they're very common and everyday for us. But I think sometimes we miss for the consumer, like what the true advantage is. So with the bank statement program, it's you're not providing tax returns at all, right?
Right.
We're not looking at those. And business owners, part of they take a lot of risk. These
Yeah.
are folks who really, in my opinion, contribute to our local economy in a great way. They're adding jobs. There's a lot that they're really giving to their community, and they take risk.
Mhm.
And in that, they have the ability to leverage tax code and
Mhm.
reduce their taxable income.
Mhm.
And so that's never a true, or usually it is not an accurate depiction of their true ability to repay a mortgage if we're
Right.
looking at tax returns.
That's right. Exactly. Okay, great. So now we're going to go into another product in the non-QM suite, and that's the DSCR loan. So, what should buyers know about this loan, and how do they work for someone looking at investment properties?
So I think it's best to start with explaining what do those letters stand for, right? What
Yes.
is the DSCR loan? So it's debt service coverage ratio. Simply put, we're looking at what are the expenses associated with the property relative to your income. So there's no personal income. Again, this is a loan. You're not providing tax returns, which is wonderful for folks. The DSCR loan is great for someone that's just new into investing and they're looking to build wealth by adding to their, their real estate portfolio. But
Mhm.
also, you have very savvy investors with a large portfolio of properties. So there's a wide range of clients whose needs it serves. But the biggest thing is the lack of complexity of tax returns. Think about if someone has 15 rental properties.
Mhm.
The complexity of that tax return, it's very cumbersome just providing all the lease agreements, all the documentation around the mortgages and the taxes and the insurance, and some are cash flowing and some aren't. So when you're looking at tax returns, that could impact your ability to buy that property that might have wonderful cash flow. An example would be maybe your expenses on that are 3,000 a month, but your rental income is projected to be 4,000 a month. But
Right.
if you have your all the other properties you own and all the other income, those things, brought into the equation, you might not qualify for that loan. So we strip all that away with a DSCR loan. We're only looking at the property that you're looking to purchase or refinance and the cost and the revenue associated with that property.
Mhm. And maybe it's just a credit score, correct?
Well, a credit score, yes. But I mean,
Right.
really,
Yeah.
I'm speaking in specifically to like income requirements. But yes, credit
Right.
score is
Right.
a very important part of the equation.
Yeah. No, it's an amazing product. It really, really is. Okay, great. So here's a good one. So for non-QM, do those loans automatically mean higher rates or bigger down payments? What do you think?
They don't. And I think that's probably another, if I were to give a two-part answer to the one of your previous questions, which is what's the biggest misconception, does my second answer would be that the rates are higher. I would actually argue, depending on the loan program and overall profile of the borrower and the property, et cetera, they might
Mhm.
be lower in some cases. We are finding on an investment property or a second home relative to your agency, so your conventional Fannie Mae, Freddie Mac loan, they might be more competitive from a rate perspective. When they are higher, such as like maybe a bank statement loan, it's marginal. And one benefit of a non-QM loan is our loans don't have PMI. So
Mm,
even if you're not putting 20% down, you don't have
right.
that additional monthly expense of PMI. To
Right.
your question about the down payment, we offer programs with as little as 10% down. So no, they don't require a high down payment.
Mhm. Yeah, perfect. Love it. And so for someone listening who may think, I've been told no before with another lender, what would you want them to know?
Well, first, I think that I'm sorry, because that's, when you're on that journey of buying a home, that can be really kind of a punch in the gut. It's demoralizing. You've gone to an expert and they've told you no. That
Right.
doesn't feel good. So I
Mm-mm.
would say first, what you should ask is, was I evaluated based on the correct program? Because
Mhm.
really, it's probably just a mismatch with what that lender offers and the program
Right.
that you need. That doesn't mean that anything's wrong with you, your profile.
Right.
Um, and I would say that that's not the end of your story. So I'd probably tell them to call Julie too. Um, but I would say definitely make sure that that's not where it stops. I think another general advice that I would give is As much as folks are well-meaning, I would always make sure that you're getting your advice from a mortgage professional, not
Right.
friends, not family, not colleagues, who, again, they're all well-meaning, but that's not their area of expertise. And just because someone purchased a home, their situation is very different, right? Um, so I would say don't give up, you know,
Mm-hmm.
and make sure that they seek a second opinion,
Mm-hmm.
and they're asking the question, do you offer alternative solutions,
Right.
right?
Yeah.
And
And to
you know,
research that. Yeah.
or non-QM, right? They can lead with, hey, do you offer
Mm-hmm.
non-QM loans?
Right.
That's the easy identifier.
Right, exactly. Just ask, do you offer non-QM loans?
Right,
And then
right.
research too, because I've had many clients who have found me on the internet because Cross Country and our team does originate non-QM loans. And
Mhm.
for me personally, I think it's at least 35 to 40% of my overall business,
Yep.
which is really, really exciting because I get to say no less than I used to. So I'm truly grateful for these products. So all right. Now we want to get to know Katie a little bit more. So I'm going to ask you a question that's kind of fun. It's like, do you have a money tip that you live by?
Know your cash flow, right? And I think
Okay.
it's really important what's going out.
Mm-hmm.
Certainly what's coming in is important, but to me, more important is what's going out.
So like budgeting and looking at all your overall expenses.
Budgeting, yep.
Mm-hmm. Do you
Budgeting
do
and really paying attention to where you're spending your money, because
right?
I think it seeps out.
Yeah, it's really interesting because it's easier than ever to do this. Like I have my bank account. I mean, I can click on this one button. It can tell me all the restaurants I've been to, right? And how
Right.
much money I spent on there. I'm like, oh, I don't know if I want to look at this, but it's
Yeah.
good that we have, that is so easily available for all of us. So I love that.
Yep.
And then what about a must-have kitchen appliance that you can't live without right now?
Hands down, my Nespresso machine.
Ah, yes. How many
I
how many
must start
cups?
my day. Well, I've had to cut back, but I start my morning with two espresso shots.
I love it. Are those two different, like you take two into one shot, or do you
No,
have
I
two
pace it out
taste
so
it
I can
out?
enjoy it
Okay.
more.
Any cream?
No cream, no sugar, no
Wow.
flavor. I love the taste of a strong espresso.
Mm.
And I've actually started now switching it with decaf in the last
What?
2 weeks. Yes. So I'll
Are
do
you
one
okay?
regular, one decaf. I'm trying to be. It's because really it's the taste. I'm not
Ah,
necessarily looking for the jolt that I get from the caffeine.
fine.
It's just I
Okay.
crave the taste. So, yeah,
Have you had any headaches since you took away the caffeine?
I have.
Oh,
Yes.
yeah. But
Yes.
hang in there. See what
It's
happens. And
short lived.
yeah,
Yeah.
let me know too.
I will.
Okay. All right. So my last question is, if you could leave first-time buyers with one piece of advice about non-QM products or alternative lending solutions, what would it be?
Don't make assumptions. Speak with the expert, and don't let someone discourage you from pursuing your dream of home ownership, despite being told your income doesn't fit the box.
Hmm. I love that. So research more, don't give up. I always love to say it's not a matter of if you're going to buy a home, it's a matter of when.
Right.
So, work with a lender that has a plan, that has a variety of amazing products. And if you're not ready now, they'll set you up, for success in the future, whether that's 3 months, 6 months, or a year. But, those dreams can come true for sure. I've seen it day in, day out.
We see it every day,
Yeah, that's
right?
right. That's right.
Yeah.
Well, thank you, Katie, so much for your time. This is so informative. If anybody wants to hear more from Katie, we will let you know how to get a hold of her or just reach out to us and we'll give you that information. Thanks so much, Katie.
Of course. Thank you. It was a pleasure being with you, Julie.